Hello everyone, welcome to another episode of TWL. TWL is nothing but Together We Learn. It started off as a internal learning session for Vite team members to learn something from the economics of the world and the financial side of the world. And that's how it started. And today we want the general public to also understand and learn more about these different things that are happening around the world. So today's topic is very interesting, mainly because it's one thing that we all really want to crack, which is how can we spot that undervalued stock, right? And the moment, and you all know that if we can spot that undervalued stock, then the kind of returns that we get, or in our entire conversation today, we're going to talk about something called as earnings. So then you'll be able to spot which stock is giving you better earnings, right? So that's the whole concept today. Before we get started, I want to introduce myself. I'm Brithwin. I am one of the product heads here at Vite. And what I predominantly do is I take care of the mobile app that we have available. So Vite is a financial wellness platform, which is available on both iOS and Android. And our primary objective is to help individuals like you and me take the right financial decisions, right? And for us to take the right financial decisions, we believe that we should all have the right information. So if you see here on this topic itself, we are talking about P&E ratios, PEG ratios, and multiple other important metrics that you need to look at, and the kind of myths or kind of pitfalls that we fall into while we are looking at these information. Right, that's the main topic for today. Without any further ado, I'm going to get started. So the weirdest thing about the stock market is that it is an order-driven game, right? What I mean by order-driven is it's nothing but if Rithwin is ready to sell, someone has to be ready to buy it, right? And that's how the whole market works. And what happens is both Rithwin who's a seller, and the buyer, both of them think that they're smart because they think you're ready to sell it and you got the value that you wanted, and the buyer is like, I got it for cheaper, right? So in the end of the day, it kind of boils down to it being a relative measure, right? So what we mean by that is what I think is the right price to sell and what another person in my own team or my own family thinks is the right price to sell would differ, right? And that's the complexity that the stock market brings into its whole play, right? So today's conversation will be to talk more on that information and how we can spot the right stock, right? So just like how when we are taking any decision, there is a common sense that plays like a major role in it, right? And we believe that will ideally protect us from most of the bad decisions that you might end up taking. Similarly, even in the stock market, there is a common sense that you can play towards. So for instance, very simple thing, when you want to buy something, we always end up buying it for cheap, and or do we end up buying it for expensive, right? And we mostly prefer the cheaper option. The answer is obvious. So in market terms, that means cheap is equal to undervalued. And when you are going for something expensive, it is called overvalued. And we might be hearing these terms on ET Money or on like Economic Times and other places where you will see these terms saying overvalued, undervalued in the news. So that's something that you have to understand. It's nothing but something that is cheap is termed as undervalued. And that's what we're trying to spot during this entire exercise, right? So for us to identify the undervalued shares, these are the few ratios or few terms that people generally look at. PE ratio, price to earnings, which is something that everyone knows about. Anyone who's starting out, this is the first thing that you jump into. Similarly, there is price to book value, price to sale, price to cash flow, PEG ratio. There are multiple different ratios, but today we're going to concentrate on two important ones. I'm not going to tell you which one, but I'm just going to talk about it. These are the more common ones that are out there. So first and foremost, PE ratio, price to earnings ratio. It is an indicator that tells us if the current market price of a particular stock is expensive or not, right? And the formula is quite simple. It's nothing but on the numerator, it is market price, and on the denominator, it's earnings per share. And I'll tell you more about what earnings per share in the next slide. but this is what PE ratio ideally has, right? And the EPS, which is earnings per share, is nothing but in the loss and profit or profit and loss statement, this will be the last item that is mentioned in it. And the reason why I'm saying profit and loss statement with more emphasis is because in the accounting world, there are multiple different statements that are available. Cash flow statement, profit and loss. Similarly, there are other terms that are also floating around. But for understanding earnings per share, we need to understand or read the profit and loss statement, right? So profit and loss statement is nothing but income, reducing the taxes, the expenditure and everything. Whatever you get, which is the final earnings that you have, that is, you get an earning and then you divide that earning by the amount of shares that are floating in the market, right? So that gives us price to earnings ratio. All right. So from here is when we start realizing whether a company has surplus of business, which means it has EPS could be on the higher end, which means it's making more profit, right? Which means per share you're getting more earnings, right? So that's something that we have to be very aware of. So now let's take an example of how PE ratio can be resonated across into the world and how we can consume it. So for instance, if the market price is 100 rupees for, let's just say, X stock, and EPS, that is earnings per share, is going to be 20 rupees, then the PE ratio is going to be 5, which means we actually need 20 rupees earnings, 20 earnings for the next 5 years to get 100 rupees, which is what the market price was. Right? So it simply means the number of years the investor has to wait to actually get that money back. And again, this is us assuming that EPS is constant. Right? So that's something that you have to be very careful about. Now, coming into a very important question for the audience here. You're more than happy to use the live to ask questions or even comment on what you think is the right answers here, right? And we are on live, so you can also comment on this. So let's just say, if you want to get your money back, would you prefer getting that in 5 years, 10 years, or 3 years, right? And if it was me who's answering this, you guys can answer yes. But if it was me who's answering this, the obvious answer is going to be 3 years. The faster I invest and faster I get it back, better for me. So that is where you need to remember that when the PE ratio is lower, it is better. Which means, like how I said here, if the PE ratio is 5, if it's going to be 3, then it's better because I'm going to get the money back faster, right? Now, keeping this in mind, what would be your choice of investment? So let's take 2 examples. Before I even start with the examples, remember, we are not recommending any of these stocks or any of the stocks that we are mentioning here. We are not recommending it. It is just for the sake of conversation. We've taken these examples out, and these are all very recent data, like as recent as 3-4 days back. So just consume it just for the learning purposes, and then from there you can do your own analysis and take calls, or always reach out to our team so that we can help you out. So let's just take an example of Colgate Palm Oil and then Jindal Steel Power. The market price of Colgate is 1570 and earnings per share is 38.8. Now the PE ratio here is 40.2. Right? Let's not forget, which means it takes 40 years for you to get that money back. Whereas Jindal Steel and Power is for 577, the market price. Market price is nothing but the amount of price that people are willing to buy it for, right? 577 rupees. If I give, they will give me 1 share, right? Now, earnings per share is going to be 41.4 rupees and the PE ratio is 19.5, right? Now, on the comments again, please do mention which one do you think is better. So now, I would want you guys to give your answers. I'm going to pause for 5 seconds for you guys to do that. 5, 4, 3, 2, 1. Now, the obvious answer that we all would think is going to be Jindal Steel Power, mainly because it has 19.5, which means you get the money back 19.5 years faster. But what we all missed out on looking at is that the industry average For instance, FMCG, which is fast moving consumer goods sector, which is where Colgate kind of falls under. So there it is 58 is the industry average, whereas Colgate's is only 40, which means it's much better, right? Whereas on Jindal Steel and Power, which comes under the steel industry, where the average is 14, which is within 14 years. But if someone had invested money in steel in Jindal, then they would have had to wait for 19.5 years, right? So that's something that you have to remember, because like I said in the beginning, it's a relative term, right? It can't be, you can't compare from one industry across to another. You have to look at it like this, like more in depth. All right. So in our case, Jindal would have turned out to be an overvalued stock compared to Colgate. Right? So that's something that you have to remember, and Colgate is undervalued among its peers. And this is a job of most of the analysts and our team members here to kind of look at, to pick out these things across the financial market. And there are across 6,500 different stocks available in the market. So it's important for us to look at these undervalued stock and accordingly make decisions around it. Now, coming into the global ecosystem, just to give you a lot more perspective, right? FIIs is nothing but foreign institutional investors. These are institutions like, for instance, pension funds in other countries where they would want to invest in India so that they can get a return back. And practically speaking, they would want to get their return back faster. Now, if you see in India, 2021, 2022, and 2023, as like how we've shown it on the graph, it shows that it is less. It is like FIIs are taking their money out. They're withdrawing more from the Indian market. Now, why do you think it is happening? Yes, there are a lot of macro reasons and global headwinds because of what's happening in Russia, China, and multiple other places, COVID itself. But there can there also be other reasons behind it, right? And during our conversation, our advisors, they do provide this update every day morning for our community. For them, we talk about this FII and DII every day. Now, for you to understand that better, I'm going to show you a data of what is the P and E ratio in other countries. And maybe when you start looking at it, you'll start realizing why foreign institutional investors are taking money out. For instance, let's take an example of Brazil here on the list. The P and E is only 4.32, which means you can get the money back in 4.32 years. Whereas USA is 21, whereas India, which is on the last one, number 30, which is at 23.11, right? Which means if a foreign institutional investor, let's just say a pension fund in the US, is investing in India, they have to wait for 23 years to make that money back, right? Returns is different, but to make that same, if they're investing 100 rupees in India, they have to wait for 23 years to get that 100 rupees that they invested back, right? So that is something that is very important, and that's the reason why they prefer taking their money elsewhere, right? So India today is expensive. If it's expensive, it is overvalued. That is where India is at. And you'd have seen multiple news, like I said earlier, on Economic Times and Financial Times, where they talk about India's market being overvalued, right? So, for instance, in Korea, it only takes 7 years, whereas in India, it would take 23 years. So, which is a better option for the FIIs. But the Indian market is not doing bad, or it's not having a huge impact, mainly because while the FIIs are taking the money out, the domestic institutional investors are pumping money in. So, it's getting nullified. All right. Now, all of this we spoke about right now is keeping in mind that the earnings per share remains constant, right? And this is where like retail investors make mistake, like beginners who get into stock trading make mistake, where they excessively rely on just the PE ratio, right? Now, what you're not thinking about is what if the earnings per share increases, right? What if that happens? So when earnings per share increases, the PE ratio can go down. But would you actually know what is the potential for that increase? So that's something that you need to look at, right? So I'll give you a classic example which happened with Jindal Steel's quarter. Like last year, September quarter, their earnings per share was 1.96, which has grown to 5.08 by December, within a quarter, which according to general public, it is 500% increase, right? So now, if this happens, would you want to jump in on that stock and then invest there? Because it is more lucrative and it's more better on investment, right? So that is what you have to realize. And for that, you need to start looking at something called as a PEG ratio. PEG ratio is nothing but price earnings to growth ratio, right? Which is, as a formula, it is just a relationship between the PE ratio and the earnings growth over a specific period of time. So let's just say if PE ratio was 100, just say an example, if it's that big, it's going to be very tricky for anyone to invest in it. And the earnings growth is going to be 500%, then it'll be 1 by 5, right? So in the market, if the PEG ratio is less than 1, then it's considered good, which means the earnings is actually doing really well, that the denominator is kind of making the number less than 1. Right? So that's something that you have to remember when it comes to looking at these stocks, and not just look at PE ratios. Right? Now, coming into the Sensex, right, and the history of Sensex in the last 10 years, you can see that India started off with something around 15, 16, like in 2014. Right, as a PE ratio, and over time it even shot up till, like, in 2021 during COVID time, it shot up to like 35, and then now it's come down to like 23 or so. Right, now you need to understand that these changes have happened due to multiple technological, macro, structural shifts that have been happening, but even then our market is overvalued. Why? Because of how it used to be like almost 10 years back. Right. So now, coming into talking about the trends in India, this is again to give you a little more of higher level overview on how people might miss out on these trends or miss out on these important crucial pointers or indicators, I would say, is that generally, like FMCG in the FMCG stocks, the PE ratios are relatively high, right? And currently it's around, it's averaging around 50, the PE ratios. Now, if you look at that, but still, and why I'm saying it's 50 is mainly because people are ready to pay more market price for that same stock because they think these stocks are really good, and it is, as a sector, it is more or less very consistent business. So let's take an example of COVID. Would we end up not buying toothpaste or toothbrush just because COVID happened? Because it's an essential, so we keep buying it. Right? So hence FMCG industry has a high PE ratio because the market price that the investors are ready to pay for it, they're okay to pay a higher premium for it. All right. Now, similarly, if you look at the IT sector, right? IT sector during COVID was very high. It was at 30, more than 30, that, I mean, to be honest. And then now it's come down to 20 and below. And the reason being, people are not ready to pay the higher market price that it is asking for, mainly because they know with COVID happening and multiple other reasons, and the recession itself, where the company has gone into recession, like investors know that in the future the earnings would be less because global companies are not ready to invest in tech. I'll give you a classic example. It's from one of our market updates. There was a news that Byju's went through a small layoff and they cut down their entire tech team. And the reason why they said that they wanted to cut that off was because of the market scenario. And they said up till next year, they are not going to release any new features. Right? If they're not going to release any new features, why would these tech companies and other giants, how will they get more work, more work orders coming in? So that's the reason why the market's not ready to pay that higher premium. Now, similarly, in the steel industry, it's the same case. Again, the PE ratio is only 10 because the market wants to charge more and make people buy more, like increase the market price. But the investors are not ready to do it because steel industry is very cyclical in nature. What we mean by cyclical is nothing but when, like for example, when recession happens, the spending capacity of people go down, which means people buying cars will reduce. If they're not buying enough cars, then the steel industry does not have to make more, like produce more steel, right? So it's cyclic in nature, right? So because of this, the market is not ready to give the higher premium that it's asking for. Hence the PE ratio is low, right? Further, with the whole supply chain issue that's happening in Ukraine and what happened in COVID, China because of COVID, the lockdown, all of that kind of played a major role here, right? Now, major factors that you need to look at PE and other pitfalls is that people make a lot of changes. People take a lot of tweaking into their statements and the way they run their business just to impact the earnings per share or the market price itself, right? Because these are the two factors that affects PE. So, for example, from an earnings or sales growth perspective, what happens is like income statements can have like one-time gains. Like for instance, let's just say if you're getting a tax rebate from the government, which might be a huge rebate value, they would show that as part of an income and say that, oh, now because of that our profits are increasing, because of that our earnings per share is increasing, right? Similarly, there are different accounting methods, right? Like cash flow, there are different methods available. So when a company switches from one method to another, they might do one method this year and next year they'll decide that let me switch it so that they can show more profits or change the values, right, in their profit and loss statements. So when that happens also, the revenue will be shown higher or the profit might come up higher. So it's important for you to always look at these metrics, and analysts kind of sniff out these things that are happening, right? Now, another thing is the way they would change their depreciation charges on their balance or on their balance sheet or on their profit and loss statements, which is nothing but, let's just say, if they're buying a product for 10 lakhs, they can't show it as 10 lakhs immediately. They have to show it across the time. So that is something that they would do it like that. Instead, it is actually right now they bought it, right? So those kind of changes they would do. Similarly, advanced revenue booking. So a classic example of this would be, let's just say, subscription plans. So they would say that they've gotten subscription for the next 5 years, right? But they would have gotten the subscription today, but they'll show it as this year's earnings, but it's actually the next 5 years earnings, right? They are supposed to divide it like that and place it in their statements, but they don't, so that they can just show more profit. Similarly, operating margins, which is like the top line, which is where you start all your expenses or what kind of the operating costs that are coming into picture. So they also try to tweak in that, right? So for example, companies might end up showing capital expenses, right? For instance, let's just say you're running a campaign wherein you are running a marketing campaign and saying that because of this marketing campaign, I'm going to get customers for the next 1 year or next 3 years, in the next 3 years, which means you're going to get 1 billion customers maybe, but you have no proof of that, right? So they might end up, ideally what you need to do is you need to split that and accordingly show it in your statements, but they don't. Instead, they would show it as a complete expense right now, right? So those kind of things is where they end up making changes. Another important thing that most people are not aware of is they don't write down assets with impaired value. What we mean by impaired value is, so let's just say we're buying a machinery and the machinery's value is 10 lakhs. So after 1 lakh depreciating count, what you take, you will put it as 9 lakhs. But suddenly that machine gets a new model in the market. So when that happens, ideally what happens is, if you're selling that machine tomorrow, you won't get 9 lakhs. You only probably get 7 lakhs. So you need to report this in your expenses column in your profit and loss, right? Which they don't end up doing it, right? Similarly, this is a very common thing, uncollectible accounts, account receivables, which is nothing but you have given the goods to them, but you would probably have to get that money back only after 6 months, or they are not probably giving it to you. In those scenarios, you're supposed to show this as loss, or you're supposed to show this as your own expenses, right? Not anything that's coming in the future, you can't say that it could come, or they won't even leave it in the books. They kind of hide it, right? So, for instance, what happened in Satyam and in Kingfisher's scenario was the same thing, where Satyam showed that they had a lot of FDs when they really didn't, right? And people believed that they did, and later on when analysts started looking deeper into it, that's when they realized that they didn't have any FDs. It was all just a facade that was created just to increase their value in the market. so that they can get what they want then and there, which is more money from the public or more money from the investor. Now, having spoken about these important things that people could tweak, there is another important thing, which is your trailing PE and your forward PE. Trailing PE is nothing but your earnings per share, which is in the past, which is what you can calculate easily as part of your PE and E ratio, right? Whereas forward PE is nothing but what the company could earn earnings per share in the future, right? So typically the analysts they listen to these quarterly earnings call, and there'll be these analyst calls which are available to all publics. Like even today, if the watchers today want to go and check it out, you guys can go check it out. It'll be there in the website or on their YouTube page, wherever they are publishing it. So this is where analysts will ask them a bunch of questions about, okay, are you planning to get a new contract, right? Let's just say German government is kind of giving some extra contract to India for a particular company. Then you could probably say that because of this, the earnings per share could increase in the next 5 years, right? And that's very important, right? Like the trailing PE can help you decide which stocks to kind of start looking at. But the forward PE is what the retail investor should look at to see the potential of it in the future. And that's why we're saying it's very uncertain and it's always relative. So it's always good for you to kind of make sure that you are covered, right? Now, similarly, when you're looking at PE ratios, don't look at just the blank PE ratios, look at adjusted PE, which is nothing but when you have these one-time payments, like for example, relocation expenses, maybe lawsuits or layoffs, right? For instance, in layoffs terms, because there's a lot of that in the news, let's just say when a layoff happens, the company has to give employee severance. Right, so that severance is a one-time thing. It's not going to be every year they're going to lay off like this regularly, right? So in those scenarios, you need to take that out of the equation and then calculate your PE ratio. So that is called the adjusted PE ratio. So in short, what we want to kind of tell everyone is that PE ratio is not just the only thing that you need to look at when it comes to judging whether a stock is undervalued or overvalued. There is a lot more layers attached to it. And why PE ratio is taken as a very basic initial filter by the analysts out there and the companies who do this, right? Even us, when we take it up. So the reason why we do that is because out of the 6,500 stocks, we can't look at every stock's underlying data, like their cash flow statements, etc., right? So we take the PE ratio as the guiding body to filter out, let's just say 100 or 200 stocks, and then deep dive into it more, right? So that's something that you have to remember. And there's a lot more in this world, and there's enough content out there. And if you guys would love to talk to our team, please do check out our website as well as sign up on our mobile app, which is available on both iOS and on Android. And one more thing that I would love to share is TWL happens every week at 11 a.m. On a Saturday. So do subscribe to the channel, hit the notification button, and if you have any comments or feedback or any topics that you want us to discuss, please do share that on the comments down below. Thank you.